You got to turn. All right.
Take it.
You guys are here. I think we're streaming. So, all right, welcome back. Anyone watching on Meerkat? Currently nobody. Humphreys, where are you? So our popularity is increasing by the second. The first one's going to be a 100% gain. So you guys try to stand in front of the camera.
It's funny, it's
sector
backwards.
presentation. What's that?
It's mirrored. It's
Zero now.
Zero
watching.
now watching. So
Great.
Are we
anything's
supposed
in it.
to
Oh, no.
capture the
Humphreys looks like he's on. Thank you, Humphreys. All right,
Humphreys.
one. So we're good to go now. Financials, take it away.
Humphreys, do you want to see the actual screen? There we
Make
go.
sure you can
It's just
see
backwards.
you guys, though, on the screen.
All right.
You can't see yourself in the little box. You know, nobody else can.
Good evening. We are doing our financial sector industry analysis. My name is Shirley. Ben, Andre.
The other way around.
Okay. So the financial sector, the major industries that we covered are the 5 up here. We have 1, insurance, 2, banking, 3, credit financial services, 4, real estate, and 5, asset management. And when we're talking about these industries, for insurance, we're mostly talking about life insurance and non-life insurance, which includes property and casualty. And a lot of this, in this industry, it relies heavily on GDP growth for key drivers for the insurance sales growth. And successful insurance companies, they strike a balance between short-term risks and long-term rewards. 2, for banking, we're looking at mostly big major mega banks as well as regional thrift banks. And in this industry, the U.S. Banking industry is entering into a new phase from the post-financial crisis, and this includes also new challenges. For example, cybersecurity, and the banks now are devoting a lot more resources to enhance security and vigilance. Banks in the U.S. are highly leveraged, and interest rate plays a big role in banks' profitability. Third one, credit and financial services. These are mostly like credit and charge card services, as well as electronic transactions and payment processes. And the weak economy also affects this industry, where it increases loan defaults and it forces higher net charge-offs. And 4, for real estate, we're looking, it covers mostly the brokerage, leasing, and management companies, as well as residential and commercial too. And in the U.S., the real estate industry is very fragmented. It is also a cyclical industry, and it fluctuates in interest rates. So the fragmentation, about 50 of the largest companies in the U.S. make up for about 20% of the industry's total revenue. And lastly is asset management. And this has been a very profitable industry in the financial sector. And also the economic strength, as well as other demographic and market trends, also feed into the industry. So for example, growing population of retirees and accumulation of wealth and investable assets also affect in the volume as well as transactions, and this translate into profitability in this industry. I'm going to turn it over to Ben and Andre. Oh, some of these are the major players in each of the industry, just putting it out there.
We next took a little bit of a look at how our sector performed comparatively with the other sectors in the portfolio. Now, this is an absolute view because we don't have the actual dates when each companies in our portfolio were acquired. So it looks like the best performers are the best performer is the healthcare sector, and followed by the tech. And financials not farther behind, with about 18.2% of returns and only 14.3% concentration in the portfolio. We see energies taking a dip because of the latest developments. We're looking at the company profiles here. We took a few metrics, and then I'll let each team member to cover their own companies.
So we, two of the funds that we have in the portfolio right now are TD Ameritrade, which is a diversified financial services company, and Banco de Popular, which is a regional bank headquartered in Puerto Rico with branches in New York. It looks, not telling from the graph right now, but we've actually extracted a lot of value off of the Banco de Popular security. Over the last year and a half or so since we got into the firm, it's grown about 25 or about 15%. So we've extracted quite a bit of money out of it here, and the profitability figures and the growth have to do with some reorg that they've done recently and taken some hits on their balance sheet. But overall, it's pretty strong signal from analysts on the equity. TD Ameritrade, they're a little bit of a different story. They extract a lot of fees from their investment services. So even though the banking sector hasn't had the strongest growth, they're pretty well hedged because they gain a lot of income off of fees. So these are some other funds that we've looked at as potential competitors to each of these securities. So you can see how they perform. TD Ameritrade pretty strong as far as operating margin and net margins, where Banco de Popular the last year, 2014, looks like they took a pretty big hit, but the performance of the stock has actually been relatively strong. Pass it back.
So the other two that is in our portfolio is Citigroup and Visa. So just talking about Visa really quick, Visa, the operating margin and net margins are also very high. They don't have any debt on their balance sheet, so that is also a big advantage for having this company on there. So comparing to the peers, they're doing pretty well, and they have a pretty strong balance sheet as of date. And for Citigroup, operating margins are a little bit lower. I mean, they're in a different. They're not in the same business, and there's a little bit of Citigroup's is still a little bit more expensive compared to its peers, but it's doing pretty well, and it passed the 2 stress tests, so that also increases investor confidence in their business as well.
My companies are Wells Fargo and Capital One. Again, for Wells Fargo, what's noticeable is the fantastic operating margin and net margin for a really large bank. They're also having a pretty good PG ratio, which means that they have a good estimated healthy relationship between their earnings growth and the price to earnings ratio. Capital One, similarly, they activate more in the credit card services. About 60% of their business is credit cards, and they also have a strong balance sheet and consistent management and pretty healthy numbers across the board for including operating margin and growth. Here we took a look at all the companies in our portfolio to see the percentage of change that occurred since we bought the position in the portfolio. And I also I made a comparisons with a year-to-date change and 5-year change. So for example, we see that Banco Popular appreciated 28.8% since we bought it. It appreciated 18% in the last year, and it appreciated 57.6% in the past 5 years. So we captured about half since we bought Banco Popular. I'm not sure exactly when that is. These were early March numbers. In the portfolio, Citigroup actually took a loss minus 0.3%. Wells Fargo appreciated really well, 63.4%, and Visa almost 3 times over. So I think we bought Visa a long time ago because in the past 5 years, Visa appreciated 107%. So 367% is a good deal. In terms of the financials, the market metrics, these are comparative price to earnings. We see, as Shirley mentioned, that Citigroup is a little bit overvalued compared to its peers. Ameritrade and Visa have really high PE ratios, indicating the expectation of investors that these are high growth companies and really healthy. Next, we look a little bit at the breakdowns of revenues and net income. For example, Wells Fargo, 57% of its business is generated from consumer banking. That's their best place, and 53% of their revenues comes from consumer banking. We see that they're concentrating. They're trying to develop their asset management side. 16% of the revenues come from there, but only 7% of income. So they're basically funding that with other revenues. Do you want to talk about Citigroup or just? I'm just gonna run through these slides. With Banco Popular, I just showed not necessarily where they're deriving their revenues, but more like from what markets, and 60% is in net income is from Puerto Rico, and 40% of net income is from the United States, but only 18% of operations is in the United States. So they're doing a good job in the United States. We next took a look at the try to emulate the concepts that we learned in class in terms of investment philosophy. We looked at the margin of safety. The overall PE ratio for the financial sector is 1860, for the banking industry 17.9, for credit service 20.4. Except for Visa and Ameritrade, all the companies in our portfolio are below these numbers. We're also making sure that we're trying to look to make sure that this is not a trap just because the fact that they have a lower PE ratio than the industry. It doesn't mean that they're actually doing well. It's just we're trying to make sure that they're correctly evaluated by the market. Yes. Thank you.
Good idea.
The next idea on our investment philosophy is circle of competence. For the sector, we looked at the following attributes. Confidence. Buffett is the largest owner of Wells Fargo. It owns about 10% of it. He's also one of the largest owners of preferred stock in Bank of America. He took a loss of about $400 million in 2010, and then about 8 months later, he bought the preferred stock at a discount price. And, well, it's pretty good. It's capitalism. Without banks, you can't have this form of economy. So this is a long-term thing. It's going to last as long as we have capitalism. Globalization means that financial systems are going to be more integrated. There is opportunity for growth for American companies. The problem is that each country have their own financial regulations and fiscal policy and monetary policy. So that's going to be a little bit difficult to assess, and security is also another reason in a global environment. Some of the wins in the industry, headwinds, we think it's regulation. Basel III is trying to improve the healthiness of the financial sector by reducing leverage and increasing bank asset liquidity. Tailwinds, we believe that rising federal interest rates are going to help the sector. Declining oil prices are going to help the sector in the sense that some of the savings that consumers will reap from lower gas prices are going to go into savings and thus increase the potential for lending for banks. And rising employment, it's always good.
Go back up 1 second.
Yep.
Back on the headwinds. So on this, what have you seen the banks talk about? So when we say Basel III or Dodd-Frank, from the companies that you look at specifically, what have you heard from management about what they're doing about this or not doing?
Dodd-Frank is mandatory regulation. Basel III is adopted as a voluntary regulation, but the U.S. Fed adopted it as a mandatory regulation as well. Most companies are trying to align themselves to that, so it's, I'll be honest, I'm not exactly familiar where they stand on these, but being mandatory, they kind of have to implement them, and they have clear schedules. I think probably their contribution is some of the Basel III requirements have been pushed back from 2015 to 2018 and 2019, and I'm pretty sure that's part of management trying to make sure that their companies have enough time to align to regulation. Independence, from Ben, I know that the analysts consider this one of the few sectors that are going to grow in 2015. A lot of analysts think that the market is overpriced right now, but given the fact that ultimately interest rates are about to rise, this will help the financial companies, and we think that this is pretty good. Another concept of our investment philosophy is Mr. Market. We see here a graph from the internet. The yellow thing is the economy stage, and the blue thing is the stock market stage. If usually it's good to invest in financials before the economy hits a trough. I think we're pretty much toward late bull in the stock market, and that means that we're about middle recovery in the economy. So the economy will still have some steam, but not sure that it's the best time to invest more in financials. Ultimately, we believe that although this is a difficult financial sector to conduct business because of high regulation, banks are actually among the very few that issue currency when they lend. So that's why you really have to keep a good regulatory eye on this thing. Technological advancements improve opportunities for growth. You have online banking, mobile banking, all of these. And the growing middle class in developing countries, not sure how much U.S. companies can tap into that, but Visa is probably the best position in the category of companies that we have to reap these benefits. And I'll leave Ben with tilts and thesis.
So we talked about the funds that we are in right now, and they're pretty well focused on either financial services or money center banks. And so we talk about financial services, we're pretty much just talking about transactional stuff with Visa, and then TD Ameritrade has their investment platforms that they make a lot of money off of. But the sector as a whole is much more diversified. So one of the things we've been talking about is how well we can further diversify our portfolio to match more the makeup of the industry. So you can see our current portfolio tilt is, we're 68% of in banks and 31% in financial services, and you can see the makeup is actually pretty well balanced of companies in our portfolio. So our growth thesis is there are high barriers to entry. Starting a bank is very capital intensive, and there is a lot of regulation. In that sense, they are a lot of competition for financial services and insurance, real estate, et cetera. So right now, the way banks make their money is pretty well lined up with the interest rate yield curve for federal interest rates. So when there are low interest rates, there's a tighter margin for banks to make their money. which would seem a good climate to further diversify out of just money center banks into corporations that have different revenue streams like Visa, or maybe looking into real estate and those kinds of funds. So you can see this is the makeup of just of our money center banks. Credit financial services is also split pretty evenly. Also high barriers to entry in the competition, and as technology improves and people start using credit cards or electronic payments, that's how companies like Visa and American Express and MasterCard are making their money. So it seems like that might be a good opportunity for us to capture some more value. Credit services are essential to commerce, so it's something that's absolutely not going away. It's just going to evolve a little bit. So here's a picture, a screenshot of some of our off-tilt industries, how we're not in insurance, and how we can maybe find some way to capture value in that industry, as well as real estate. Well, we're kind of having a tailwind for low interest rates, and we see employment rise and construction grow too. Great.
Questions?
Yep.
Barry?
So can you go back to the television page? Like the second one.
This,
Yeah. So you're speaking about tailwinds. You mean the tailwinds of the tailwinds for the sector as a whole or as a particular industry within the sector? Because as I know from recently what I know is definitely commercial banks, which is a big player in the sector, they are going to benefit from the rising interest rate because the rate they charge for their people who borrow their money will be higher,
Right.
which means their margin will be higher. But it could be, what I think about it, could be a bad thing for those asset management companies.
yeah.
Because those people who invest heavily in bond market, stock market, especially bond market, when you see a rising interest rate, the bond price will drop, and the value of their portfolio will shrink.
Right.
So we would think it's a tailwind for the whole sector, or just one particular industry?
One of the things I thought was interesting was that how our portfolio is set up the way it is, where so much of it is focused on money center banks at a time over the last 3, 4, 5, 10 years, where interest rates have been so low, and it seems like that would have been a good time to invest in a different sector that would have had that tailwind. But as far as the tailwind slides go for here, this is more applicable to the way our portfolio is currently set up with money center banks. So we're starting to see a tailwind as interest rates rise, that it might be a time where we can start seeing some improvement in profits, in net interest margin specifically, for the money center banks.
And in addition to that, this is a subjective opinion. I'm not sure it's going to work that way. Rising interest rates means the dollar will appreciate because people will invest in the dollar. Having investing in the dollar will mean that you'll have more dollars from the Fed, and that I believe it will keep borrowing costs for U.S. companies still low, which will continue to fuel their stock repurchases. So the stock market may have a bubble because of that, but stock prices will still go up for a while.
Yeah.
And the headwinds, I think, especially for banks, the amount of settlements that federal regulators are going after these banks for. I think J.P. Morgan spent $27 billion in the last 2 years in settlements with regulators, and it seems to be the new occupation for federal regulators is to raid banks' balance sheets. We see that in the large banks like J.P. Morgan or Merrill Lynch or something like that, where they're still going after them for the mortgage crisis. Do you see that in any of the other sectors here, in the insurance businesses or in the brokerages, that those may be new sources of cash for the Justice Department when they run out of banks to raid? On a serious note, though, it seems to be that banks are turning out to be, they're paying out all their profits right now in settlements, it seems. I think J.P. Morgan's last quarter, it was $1.1 billion in legal expenses, which is crazy. But we haven't yet seen it necessarily in insurance. We haven't seen it in other areas of the financial sector. know it's a headwind in banking. Have you guys seen anything, or is that a concern of y'all? Is that something that you want to weigh or explore, or consider?
Take it.
It's a good question, definitely. Banks are at the core of the financial meltdown because of the high leverage, and that's what Basel III is trying to address. As the financial sector gets more integrated, ultimately one of the companies that was at the center of the financial meltdown is AIG, which is an insurance company. But they were, because of their size, they got into a lot of other things other than insurance. And banks are also probably moving in different, like for example, Bank of America owns Merrill Lynch, which is financial services, not banking. So you have these conglomerates and more integration in the financial sector. I don't see how, particularly with the government, have more rating to do on private companies, but this is a highly regulated environment. Healthcare industry, the insurance companies wrote the legislation with the healthcare companies, so it's a tricky relationship with the government, and governments will always find the politically convenient solution, not the economically viable solution, I think. So it is subject to some further political maneuvering. in my opinion.
Well, both sides answer. Donahue.
Have you guys looked at any of these new fintech companies coming online? In terms of like, I forget the names of them, but there have been a few IPOs, and there's kind of this shift in lending, like peer-to-peer lending.
Yeah, I've looked at like Lending Club and Lending Tree are a couple that seem pretty interesting. There's not a whole lot of financial performance reporting on them yet, but you know, compared to other
Could you actually,
commercial
just
banks.
1 second, since you know about it, could you tell everybody sort of a 2-second overview of what Lending Club is, just one?
So it's basically like a peer-to-peer lending club. So it's a platform where you can go on and either be a lender or request a loan.